Momentum is a very powerful force in the markets, and so we want to always make sure that we respect the momentum in the markets, however, also making sure that we understand what's taking place underneath the surface. So if we look at the markets from a more near-term trending perspective, we have to, even maybe potentially from an intermediate term perspective, we have to respect momentum. Looking at the S&P 500, we all know it's just been a few stocks that have been leading this higher. The momentum for the index remains strong. Now, we all know, I always mention this, mean reversion is going to happen very quickly, and it's going to leave a lot of people wounded. However, in the meantime, the momentum is there. What I'd like to show you today is something that I think more people are looking at now, certainly on the institutional side, and that is what's essentially market breadth. We can look at it through the lens of market breadth. What I'm looking at here is something we track very closely. These are the 52-week highs that are made on a daily basis on the New York Stock Exchange Composite. And this is a very simple thing that can be pulled up on any broker platforms. Everyone's got a different platform, so I can't tell you the tickers, of course. But what I'm doing here is I'm looking at the fact that last Friday, only 37 stocks on the New York Stock Exchange Composite made a new high. And you might say, if you look at this close enough, you might say, well, Serge, there's been days, weeks this year, where even fewer stocks made new highs. The trouble is that every time we had such a low reading or low, it was when stocks had pulled back. In other words, stocks, the S&P had pulled back 3, 4, 5, 6, 7, 8% every time we had such a low reading of new highs. Last Friday, however, we had only 37 stocks made new highs, but the S&P 500 made an all-time high. So the divergence is getting very extreme. So this is something I would encourage everyone to watch. Now, one of the things that I think is critically important to understand here is to make sure that we're able to see, as I put it to our clients this weekend, we're able to see the forest from the trees, meaning we don't get too caught up in a little thing and kind of, the market. So we like to use our market rover to really be able to guide us through where are the trends. Are the trends still bullish? And does that allow us to buy the dips, or is the trend changing? Like, for example, copper right now. Copper's had a pretty, and we can look at the copper ETF or other ETFs. Gold is the same thing. All those things have pulled back meaningfully, but they remain a bullish trend by our algorithm. And so this is typically where a lot of people get chopped up. They see something moving up, whether it's an index, an individual stock, or in this case, we're looking at copper or a copper ETF or gold or ETF, and they don't realize, they can't differentiate between what might be just a pullback in a strong trend or a trend change. And our software is designed to tell us whether it's a trend change or whether it's a time to buy. We're going to show this week, and I'm going to show you our top 5 favorite stocks and ETFs that we like right now that are just pulling back. They are not changing their trends. I think it's an important part of the year to look at the market through the lens of what are the major trends, and is it time to buy or maybe sell certain things, because we do expect the second half of this year to be quite different from the first half. So hopefully the new highs oscillator or market breadth is going to be something you can use. And if you like to look at the market, the lens of what it might bring in the second half of this year, join us this week where we're going to use our market rover to find what our favorite few stocks for the second half of the year. As always, you can sign up for that discussion down below or on the next screen, and we'll see you there.